But I really appreciate the opportunity to say a few things about where we're seeing this economy right now and what it means for financial markets and what it means for investors. I know you have conversations with investors every day, and I can't think of a time when it has been more difficult to convey a clear, balanced message about economic fundamentals and market fundamentals than it is right now. We've been through an extraordinary time in terms of the economy and the behavior of the economy. We have not, in the modern economy, in any modern economy, seen an event like a pandemic, which basically destroyed all of our macro models. They simply wouldn't work. So we didn't know where we were going. On top of that, we've got a highly partisan political environment, which continues today with the election less than 2 months away. And then overlaid on top of that, we've got the way people get information. When I arrived in America back in the early 1980s, and back then you could turn on the evening news, and actually people watch the evening news. They watch the 6:30 news. And you could either watch Dan Rather or Tom Brokaw or Peter Jennings. It didn't matter. You could flip through them. They were telling you the same stories in the same way at the same time. And maybe it's a little boring, and maybe people made fun of it, but the truth is we were all drinking out of the same fountain of information. Today, nobody does that anymore. People are either watching Fox News or they're watching CNN. And they're getting two completely different versions of the country that we live in. And overlaid on top of that is an absolutely insidious social media feed, which cleverly figures out, second by second, millisecond by millisecond, what your prejudices are, and will feed and amplify whatever those prejudices are. And the one thing that all of these organizations have in common is that they make money by making you feel scared and angry. So whatever else you're supposed to do, you're supposed to feel scared and you're supposed to feel angry. And that's no way of making good investment decisions. So what we do in Market Insights at JP Morgan Asset Management is we try to use our guide to the markets and all the other materials that we produce to try to provide a balanced view of where things are so people can make good investment decisions. And so what I want to do today is I want to use some slides from this to talk about a few things in terms of where we are right now. I want to talk about, first of all, where the economy is and how that is setting up the market. I want to talk about asset allocation, particularly from a valuation perspective, but also thinking about where things might move in the short run. And then I want to talk about risks, both outside risks and also the risks in people's own minds, in terms of how they invest. So let me start with market fundamentals in the economy. So at the start of last year, we put out a forecast. I was trying to think of a good way of characterizing our forecast for 2024, and I thought a good way of characterizing it was 2024. We were expecting 2% real growth, 0 recessions, inflation coming down to 2%, and unemployment rate about 4%. And my big problem now is that when I come to 2025, I'm going to want to do the same thing again. And it's going to seem a little boring and maybe, I don't know, passé to call 2025, 2024, but I think that's where we are. The economy is in good shape. And I know it's hard sometimes for people to recognize that because of what we've been through, because of what inflation has done in the last few years, because we've all been through the pandemic, because of the political division. But overall, it's a pretty good economy. And I think in looking at where we go from here, the first thing that I think people need to figure out is, well, how come we're not in recession right now? I mean, I thought like 18 months ago when we had the mini banking crisis, people said we're going to end up in recession. So what happened to that? And I think when you think through this, you learn all the things that you need to know about the American economy, which makes it really unique. So first of all, if you go 18 months ago, people thought we were in trouble for two basic reasons. One, there wasn't going to be enough demand. And two, even if we could find the demand, there was nobody to hire. So we're going to run out of supply. Well, that didn't happen. So what happened? Well, if you look at this chart, now all these charts are from our guide to the markets. Just a quick show of hands. How many people here get our guide to the markets? Wow, okay, cool. Well, listen, if you don't, or if you want to sign up for it, just stop by our booth over there. I'm sure we can get you signed up. So if you look at this chart here, people thought the economy was going to slow down, but actually if you look at GDP, in the second quarter, GDP growth was 3.0%, and it was 3.1% year over year. Right now, the Atlanta Fed's GDP Now model is saying they're going to do 2.5% in the third quarter. My own numbers are telling me 2.0. That is only because inventory growth is going to slow down. Consumer spending is going to grow at about a 3% pace. So again, where is this demand coming from? Well, two places. If you look at the chart here, you can see exactly that, this is the whole story of the US economy. That big blue blob there, consumers. We are blessed in this country by having the most reckless consumers in the world. There are no consumers who are more willing to spend money they don't have on stuff they don't need than American consumers. And it really helps us. So what happened was, initially we were spending a lot of money when we got pandemic aid. That went, but we also paid down some debt. And then in 2022, we racked up a whole pile of credit card debt. And that was supposed to get us into trouble, but it didn't really. I mean, credit card debt is still growing, but delinquency rates are okay. And then over the last 16 months, real wage income has actually been positive. Wages have been growing faster year over year than consumer prices because inflation came down. And that's giving some extra oomph to consumers. Now, I will admit that upper income consumers are doing better than lower middle income consumers right now. That is absolutely true. It is not equal. But this economy doesn't count by heads, it counts by dollars. The reality is the top 10% of American households receive more than 50% of the income. If the top 10, 20, 30% of the economy is of households in terms of income are doing well, consumer spending is going to be doing okay. And it has continued to do okay. There is absolutely nothing inherent in the American consumer finances or income or sentiment or behavior which tells me consumers are going to suddenly stop. American consumers don't stop. They don't stop at the limits of prudence. They don't stop when they're supposed to stop. They stop at the limits of credit. If you will take the credit card away from their stiff, grasping hands, they might stop spending, but other than that, they won't. And that is, now I do think consumer spending will grow more slowly, but there's no sign whatsoever of a cliff here where consumers will stop spending. The second thing that has really helped us, you see that big orange blob there? That's investment spending outside of housing. And when we had the mini banking crisis, the Federal Reserve pushing up interest rates, the traditional idea is the Federal Reserve pushes up interest rates, what does that do? That's supposed to kill investment spending. That's supposed to kill the economy, except it didn't. What's actually happened is investment spending has continued to move along pretty steadily, not all of it, but overall as an aggregate it's done fine. There is obviously a slump in building new offices, and there are areas of equipment spending which aren't that great, but lots of other construction spending is doing very well. There are a lot of the money the government spent on the CHIPS Act and the Inflation Reduction Act, which is really a Green Transition Act, that's helping investment spending. We've got a lot of public sector infrastructure spending going on. We also have AI. And I believe in AI in the long run. I think it's going to change the world, just like I think the internet changed the world. Most of the ideas in AI are rotten and they're not going to work. And that's just how it is. And that's how it always is. But for right now, the most important thing to recognize about the economy is every business has to have an AI strategy. No self-respecting company can say, oh, we don't believe in AI. Oh, no, we all believe in AI. It's going to change the world. And because of that, companies who've got very good profits are putting money into AI right now. And that's also causing a lot of investment spending. You put it all together, there's nothing causing investment spending to fall. Now, if the orange blob is doing pretty well and the blue blob is doing pretty well, it's pretty hard to get the economy to keel over. But what about the rest? If you look at government spending, I was talking to some, in fixed income, I was talking to some of our muni analysts or portfolio managers about municipal finance. State and local governments are in excellent financial condition. And the thing is, they've got the money to hire, and now as the labor market's cooled down a bit, they can actually find people to hire. So that's moving up. No great cliff there. If you look at housing, home building has fallen to very low levels. We have younger households simply cannot afford to buy, or younger families are having a really hard time buying a house. And I think that one is really on the Federal Reserve. But with housing starts down as much as they're down, there's nowhere for them to go but up. This is not like the Great Financial Crisis. In the Great Financial Crisis, we had a huge surplus of excess housing. Now, if you look at vacancies, they're really low. You put a house on the market, it gets snapped up like that. And because of that, we're going to see some revival in home building, whether or not the Fed, regardless of how fast the Fed brings mortgage rates down. And then trade, well, trade's kind of a small part of the story overall. So overall, that is what's helping demand grow. And we could get hit by a shock. 21st century has got plenty of examples of shocks, so things we never expect to see coming. But if we don't get hit by a shock, this economy is going to continue to move forward with demand. You see the long-term growth rate at 2%. That's what it normally does. I mean, the economy isn't always on a knife edge between recession and expansion. It normally expands. 325 million Americans wake up every morning. They want to buy more stuff. They want to work more hours. They want to get ahead. Generally, the economy will grow. Productivity growth is strong. We're seeing employment growth. That will get the economy to grow. So that's the demand side. But then there's also the supply side issue. So on the supply side, the biggest issue is labor. I mean, and if you go back to March of 2022, we had a situation where there were 12 million job openings. And even if you go into sort of early 2023, we had massive numbers of job openings. And what's more, and you're all very aware of this, the baby boom continues to retire in huge numbers. The growth in the working age population, according to the Census Bureau, the growth in the population aged 18 to 64 was supposed to be 240,000 people per year. But if you look at payroll employment growth over the last year, it has amounted to 2.4 million jobs in the year that ended in August. And even if you allow for there was a big adjustment, a benchmark adjustment back in March, and I'm not sure how much of that is, I think most of it might be real, some of it might overstate it for kind of technical reasons because of the way they do it. But even if you feed the whole thing through, you're still talking about 130,000 jobs being added every single month. And you've got to ask the question, where are these people coming from? How are we coming up with 130,000 or 150,000 or 200,000 more people to work every month when the population aged 18 to 64 was only supposed to be growing 240,000 people per year? Well, it turns out there are two big reasons for this. One of them is labor force participation. I remember a few years ago, after the pandemic, in the middle of this labor shortage, I remember taking a cab ride from the hotel in Vegas where I was speaking at a conference out to the airport. Now, it is not a long ride, but he seemed to charge me a very high fare for getting there. But on the other hand, he did offer me an economics lesson. He had gathered opinions which he gave me. The problem, he said to me, was that millennials just don't want to work. I didn't want to interrupt him and say, are you talking about Gen Zers or millennials? But I didn't even get to go there. No, they don't want to work. They just want to sit on the couch. But that is actually not true. Yes, it is true that the labor force participation rate is down. You see that dark number there, that gray line there? That is the overall labor force participation rate, which is one of the stupidest statistics the government has ever published. What the labor force participation rate is the percentage of the population aged 16 and older that is either working or actively looking for a job. Not 16 to 64, 16 to 120. And so, of course, as the baby boom retires, and huge numbers, the labor force participation rate is going to go down. Of course it's going to go down. That's what's been going on since 2012. But if you look at participation among people aged 18 to 64, that blue line, it's actually, in April, it hit a 15-year high. Turns out if on bended knee you ask Americans to work, they will work. And so we've seen a surge in labor force participation. But the other thing, which is frankly very controversial, is what immigration has been doing to this. Now, I am not going to defend the chaotic situation at the border. We are in so desperate need of an overhaul in our immigration laws because we've seen millions of people flooding into this country. And years ago, what people would do is they'd sneak in over the southern border And by the way, I'm not making a moral judgment. I'd probably do the same thing myself if I was starving in Latin America. But they sneak over the border and they would sort of hide in Houston or Miami or San Diego and just sort of disappear. Today, they are going across the border and they're finding a border patrol agent and saying, okay, you got me, this fair cop, you snagged me. I am applying for asylum. And I happen to know the law is that if you catch me on American soil and I apply for asylum, I am allowed due process. And so, yes, I'd like a notice to appear. Yeah, thank you very much. I got your paperwork. Thanks, I've got it here. And you know what? They do show up. But the thing is that they've now got 3.7 million pending cases in our immigration courts. And the immigration judges, bless them, they got through 700,000 of those last year. And I will say this is beginning to top out. It's not, but we've got this enormous backlog. And so it will take them 5 years to get through this. So what happens over these 5 years? Well, if you are in this status, you're not eligible for Medicaid, and you're not eligible for food stamps. You work or you starve. And so what's been happening is they've been flooding our labor market. There are now fewer retail job openings than there were back in 2019. They're filling jobs in daycare. They're filling jobs in landscaping. They're filling jobs in leisure and hospitality. All of these, we've seen job openings go down and payroll employment go up because of this. In fact, this chart here, this is why I've got this chart here. This shows the growth in employment over each of the, going back a number of years. But for the last 3 years, you see the light blue area are people who are born outside this country. The dark area is the people who are born in this country. For the last 3 years, more of our employment growth has come from people who were not born here than from people who were born here. And it is highly ironic because it is obviously a very contentious issue, and people feel very strongly about it on all sides. But the reality is that this extra labor has allowed us to deal with the labor supply issue and it's built extra runway for the soft landing. The other thing that it's done, which is pretty interesting, is it's had an impact on inflation. So this chart here, we put this in our guide to the markets years and years ago. It was supposed to be one of these really simple charts, so easy to explain. The gray line is the unemployment rate. The light blue line is wage growth. And the idea is when the unemployment rate is high, wage growth is slow. Okay, everybody gets that, and that's pretty simple. Except it stopped working. If you go back to March 2022, the wage growth was at 7% year over year. Now it's come down to 4.1% year over year. And this is for production non-supervisory workers. But meanwhile, the unemployment rate has been really low. It's been at or below 4%, or around 4% since December 2021. So for all this time, when the labor market is really tight, you've got wage growth actually coming down. So what on earth is going on there? Well, two things. One is I do think the immigration surge is having an impact here because they're filling lower wage jobs, and that is bringing down the average hourly earnings. But the second thing is, and this is really another really important characteristic of the American economy, American workers won't ask for a raise. Jay Powell is fond of talking about the lessons of history. But the reality is, when he talks about the labor market, back in the 1970s, the last time we had inflation, over 25% of the private sector workforce was in a union. Today it's 6%. The other 94% of people are on their own. And they're just not, they are not asking for a wage increase. If they ask for a wage increase and their boss calls their bluff and says, okay, you're leaving, okay, fine, bye, to pack your bag, or there's cardboard boxes over there, off you go. If your boss does that too, that could change your life, it could ruin your life. Whereas for the boss, they're used to doing it. I mean, one of the things that makes American corporate profits so strong is we have got really good at holding down wage costs. There must be 50 ways to stiff the workers. And American businesses figured out every one of them. And that has allowed profit growth to stay strong, but it's also helped bring down wage growth. And it's really important because if you've got wages going at 4.1%, and you want to have 2% inflation, and if you've got productivity growth, and over the last year productivity growth has been 2.6%, well, it turns out that 2% growth in output prices plus 2.6% growth in productivity means that you can afford to pay 4.1% wage growth and actually increase your profits. This is not inflationary anymore. And that brings me to inflation. So this is our sort of, this is our long-term inflation chart. And we sort of show a few years beforehand, going back earlier in this century, just what inflation was doing. And it was pretty smooth all along, and then suddenly you get this surge of inflation during the pandemic or just after the pandemic and beyond that. What caused it was the pandemic, plus the policy response, all that COVID money, and then that was amplified by Ukraine. And what you can see is, look at all the things that went up. Commodity prices went up, food prices went up, energy prices went up, core goods prices went up. But the thing about inflation is inflation always looks a bit like an Eiffel Tower. If it spikes up, it's going to spike down. The best cure for high commodity prices is high commodity prices. And so at this stage, all those prices have gone away. And now what you're left with, you still have inflation, and it's come down. So in August, we're down to 2.5% year over year on not seasonally adjusted basis. But inflation's come down, but there's still some. But the only two areas that are really giving us inflation right now are shelter, which the government mismeasures, and that's showing about over 5% growth, and then auto insurance, which is up 16% year over year, but that's going to come down too. These two areas, auto insurance and health insurance, shelter costs, are actually quite easy to model and track. They're very smooth. They're gradually coming down, and they're going to keep on coming down going forward. I know it's been, people don't, I tell people, inflation's coming down, they say, are you kidding me? Have you seen the price? Have you bought some eggs recently? You bought some milk? You've gone to the grocery store? I'm not saying the prices are coming down. I'm saying the rate of growth of prices is coming down. You're not going to get those prices down again. And don't hope for it, because you're going to get that. You'll have to be in a recession to get lower prices in general. But the rate of growth in prices has come down. And I know it's frustrating, but it's a little bit like, I love running. That's kind of what I do. And my wife is a wonderful baker, and she's got this habit. When I come in from a long run, she makes these chocolate chip cookies, which are amazing. And she's just taking them out of the oven at just the moment I walk in the door, and the house just smells wonderful. And then I try and grab one, and I get my wrist slapped. You got to wait for them to cool down. And they are cooling. They're just cooling slowly. And that's what inflation's been doing. It's just been cooling slowly. But we're getting very good news recently. As I say, last week we got a 2.5% year over year on CPI. If you look at gasoline prices, they're down they're over 60 cents down year over year. Now, they won't stay that way. They'll bounce again. But for the moment, that's going to help us out, so that in September, I believe that personal consumption deflation in September has a good chance of reading 2.0% year over year. And in the long run, this is just not an inflationary economy. To me, you can look at the last few years, you can see that spike in inflation, but do look at this other chart, which is also in our guide to the markets. In the long run, this is not an inflation-prone economy. We don't have a strong labor movement. We've got information technology, which tends to be deflationary. We've got income inequality, which tends to be deflationary also. And so we do think inflation is going to keep on coming down. I'm not going to talk much about corporate profits here, just to say that the margins still look very good. We saw that the second quarter earnings season was fine. It still looks good going to the third quarter and the fourth quarter. Overall, we're looking at, depending on which measure you're looking at, between 6 and, say, 12% growth in operating earnings. But what's going on is we've got an economy which is doing okay. We've got companies, though, who are very good at maintaining margins. And they're continuing to do that and take advantage of productivity gains. And so all of this brings me to the Federal Reserve. So the Federal Reserve is meeting this week. I must say this is as close a call as we've seen in a long time. Usually these are very boring, these Fed meetings. This one's a close call. They will cut rates. The question is, will they cut by 25 or cut by 50? I find myself in an awkward position because I was reading some copy by some colleagues of mine in JP Morgan, who I very much respect, who say the Fed should do 50 and they probably will do 50. And I'm in the camp that they should only do 25, and I think by a very small margin they'll do 25, but please don't bet any money on that. So why should they? Only go 25, because bringing down interest rates it's like lowering a piano out of the 4th floor of a building. You gotta do it slowly and carefully. If there's one concept I want to get across today, which is so important that people don't understand, it is that there is a J-curve effect from cutting interest rates. You hurt the economy before you help it. Jay Powell talks about long and variable lags. Yes, the lags are long and variable. That's because you hurt the economy before you helped it. So what happens is, if they cut 50 basis points on Wednesday, 3 bad things happen. One, all those people sitting on CDs and money market funds, and there's a lot there, they all got a pay cut. And that will squeeze the income of older Americans. 2, if the Fed cuts 50 basis points, you know that everybody's going to say, oh, I wonder what they know that we don't know. I wonder what data they're looking at. The economy must be on the brink of recession. And that is going to get hyper-amplified in this political mood. You know that is going to get, for obvious political reasons, one side is going to take advantage of this and say, you see, they're trying to bail out, and a failing economy is just going to go into recession. And then the third thing is that the Fed cuts rates by 50 basis points. You think they're going to do some more? So you want to borrow money now? You want to wait a while? Well, I think I'll wait a while. I mean, wouldn't that make sense to take out a mortgage later? Now, eventually, when rates hit a bottom, and the next move is up, that's when you think that then you want to borrow money. But for right now, it slows the economy down, and that's what they don't get. And that's why the reason they need to only go slowly is because they will hurt the economy if they go fast. I hope they. I mean, I feel like a lot of people. I mean, I certainly have been saying this, but a lot of other people have been saying this for a long time. The message just never gets through. That's why they need to take it easy, not because they want to help, not because cutting rates more will help the economy, it's because cutting rates more will hurt the economy. Anyway, it means that we have 2 possible paths here. I think, it's very close. If they cut 50, then you're going to get more rate cuts, and you'll see it in the dot plot. They'll have to put, 3 or 4 rate cuts in this year, and then maybe 5 or 6 next year, and suddenly you're off to a significant decline in rates. I think it's possible, slightly more probable, that you'll get 2 rate cuts planned for this year, maybe 3, and then 4 next year. And that's what will come across. But it's a very close call. Either way, I think this economy has got enough strength in it without another shock to actually get by. So I think you could see a lower path in rates. I think you might get down to about 3.5% to 4%, either middle of next year or late next year. But I think we can still avoid a recession. It's just close call. All right, let me talk a little bit about asset allocation. This chart here, we put this in our guide to the markets, and by the way, we update this every morning by 10 a.m. because, of course, the numbers change. This is a great way of looking at assets. If you're talking about allocation with a client, and you're looking at, you want to look at apples and oranges and bananas, this is the way you can measure it. So what we did is we took the most popular valuation measure for each of these asset classes, and we said, well, what's the average level over the last 25 years? And that's the horizontal line. And then we said, well, what's 1 standard deviation? That's a dark gray area. What's 2 standard deviations? That's a light gray area. And then where are we right now? Those are the blue circles. And so if you look at that, well, it's pretty clear. Large caps, US stocks, large cap growth stocks, and value stocks are expensive. High yield is somewhat expensive, although I think it's less so because you're getting a decent overall coupon on high yield. And treasuries look cheap relative to where they've been over the last 25 years, but anything would look cheap relative to where fixed income's been over the last 25 years. And of course, international stocks look cheap, but what's new? If you look at, so just going into this, in fixed income, I wouldn't honestly make a big asset allocation bet right now. We're at 3.6% in a 10-year treasury. If we fall into a recession or get close to recession, maybe you get a little bit of a drop there, but you're not going to get much because the government's borrowing $2 trillion per year. And at that rate of borrowing, you're going to have to pay some sort of yield here. But meanwhile, I think credit spreads are tight, but I don't want to, I wouldn't want to bet against them because I essentially believe a continuation of soft landing. So overall, I wouldn't make a big credit bet or duration bet within fixed income. Within equities, there is a concentration problem. I mean, I get it that the mega cap 7 or the magnificent 7 have been doing very well in terms of earnings. They certainly have. But still, if you look at forward PE ratios, 28 times in the top 10 stocks in the S&P 500, about 18 times in everything else. There's an over-concentration issue. There's an over-concentration issue also in US stocks relative to everywhere else. I mean, the US keeps on going up, and it's partly because of the US dollar going up over the years, but the US is now 64% of global stock market. It shouldn't be the case that the top 10 stocks are 37% of the S&P 500. It shouldn't be the case that the US is 64% of the global equity market, and there is danger in that concentration. But what do you do about it? Let me see. So there's an old saying in finance that past performance, or it's sort of the boilerplate at the bottom of every chart seems to be past performance is no indication of future results. That's not true. Great past performance, excellent past performance, is a very good predictor of mediocre future results. And the problem is 60/40 portfolios have done very well. We've had a huge run in the stock market, really going back decades, to the mid-1980s. We've also had a run now more recently, the bond market down 3.7%. So if you look at this is something we call the earnings coupon yield. So we take the earnings yield in stocks, we multiply by 0.6. We took the yield to worst on the Bloomberg Ag, we multiply by 0.4. You put them together, you got the earnings coupon yield, which is a basic valuation measure for 60/40 portfolio. The good news is they've done really well. The bad news is we're now one standard deviation expensive. That earnings coupon yield has come right down, and when that yield comes down, that means they're expensive. And the other piece of bad news is that doesn't tell you anything about what the market's going to do or what a 60/40 portfolio is going to do in the short run. But this is what it tells you about the long run. This is the relationship between that 60/40 valuation measure, that earnings coupon yield, and return over the next 10 years. And starting where we are right now, it says 5.2%. I know your clients aren't going to be happy with 5.2% from a balanced portfolio, but that's what the numbers are saying. So what do you do about that? One of the things you can do about that, and I know that we're very interested in this, we're working hard on it, as are other people at this conference, is alts. You know, this is a chart that we put in our new guide to alts, which we just launched the third quarter version last week. So what we do here in this chart is we start with the 60/40 portfolio. So the size of the bubble tells you the yield, the height of the bubble tells you the return over the last 10 years, the annualized return, and the distance from the right axis tells you how much diversification you're getting against the 60/40 portfolio. So you start out the planet Earth, 60/40 portfolio. You know, it's done pretty well, but right now the return is where it is, and the yield is not that great. If you want to venture into the solar system of alternatives, they've all got different characteristics. You want more yield? Look at things like direct lending, private credit. Look at transportation. Look at infrastructure. If you want better returns, just a little more spice, look at venture capital and private equity. You want something that's going to diversify a portfolio away from fixed income, apart from sort of fixed income and diversifying equities. Look at things like core real estate and infrastructure. Okay. 10 minutes. So I just want to talk about 4 other things. First of all, I want to talk about some obvious risks. Number one question I get asked all the time is, isn't the debt going to blow us up? Well, this is the federal debt as a share of GDP going back to the 1940s. And you can see that it's at 99% of GDP right now, but based on the track we're going on, according to the Congressional Budget Office, we're going to be at 122% in 10 years' time. And that is if we don't extend the Tax Cut and Jobs Act to 2017. If we do extend it, we end up at 133%. And frankly, listening to, we're obviously in a political season. Both parties are talking about spending money and increasing this deficit. I do think we should take a grain of salt to this. Unless one party has got an overwhelming majority, they'll need to sweep the Congress, but they'll need to sweep it by a lot. They need to have multiple seat majorities in the Senate. Unless they do that, you're probably not going to see most of these policies implemented. But still, it's a lot of growth in debt. I will say this, though. I think it's a problem. I think it's a political problem. I think it's a national problem. We ought to do something about it, but it is not a problem for your clients to worry that much about. Last year, last calendar year, the Treasury Department raised $2.7 trillion, both to finance a debt, to offset the fact that the Fed was selling $700 billion back into the market, and to build up their cash balances at the Fed. They raised $2.7 trillion. You know what? The 10-year Treasury yield at the end of the year was exactly the same at the start of the year, and it's lower today. That tells me that global investors have got tremendous appetite for US Treasuries. We've been talking about this for a very long time, but it's wrong, I get it, I wish that we had a political system that would address this, but don't assume that that's a reason why people shouldn't invest at all, because it isn't. Second thing that I think is a really interesting risk, as well as, is what's going on with inequality. Now, we don't talk about this a lot, but this is one of the most remarkable charts I've ever seen in finance. And the reason is because these two series should have nothing to do with each other from a statistical perspective. One of them, the blue one, is the ratio of financial assets, the value of financial assets to GDP. The other one, the green line, is the percentage of income received by the top 10% of households. But look at how they fit like a glove. What's happened since the mid-1980s is we've had more and more inequality, with the top 10% getting more and more money. And what they've been doing is they have not been buying goods and services, they've been sending it to you. And you've been investing in financial assets. And that has caused financial markets, both stocks and bonds, to bubble up, even while inflation has remained relatively low. Now, that has worked wonderfully well for financial markets and for the business that we're all in. If there's one chart behind the prosperity of you and your families, this is it. This is what's been driving it. But there is a problem here, because it is leaving a lot of Americans behind, and eventually you can end up with stupid solutions because, being implemented because the people in general are just so mad. And that is a risk. Having said that, I'm going to make my usual plea once every 4 years, is please don't let how you feel about politics overrule how you think about investing. This chart here is something we put together using data from the Pew Research Institute. So the Pew Research Institute, going back to 2000, has been asking people about the state of the economy. Not where it's going, but where is it right now? So how do you feel about the economy today? Is this economy excellent, or is it good, or is it fair, or is it poor? And then they ask, one other question. Do you normally vote Republican or lean Republican? Do you normally vote Democrat or lean Democrat? And they put it all, and we put it all on a chart. And it is extremely enlightening and depressing at the same time. When George W. Bush was president, all the Republicans thought the economy was doing great, and the Democrats thought it stunk. As soon as Barack Obama becomes president, and in the middle of the great financial crisis, the Democrats think the economy is recovering, and the Republicans think it is not. As soon as Donald Trump becomes president, the Republicans suddenly think the economy is doing brilliantly, and the Democrats think it's not, and it reversed again when Biden became president. Pretty interesting for sociologists, and it says something pretty sad about the state of the information flow that people are getting. But it is also important because we know that people tend to invest to some extent based on how they feel about the economy. And that means there are a whole pile of Democrats who missed out on great returns under Donald Trump, and there are a whole pile of Republicans who missed out on great returns under Barack Obama and Joe Biden. Do not let how you feel about politics, no matter how strongly you feel about politics, don't let it overrule how you think about investing. There's one last chart I wanted to put in. This chart's not from our guide to the markets, but I think we should add it. This chart is just looking at asset allocation, a diversified portfolio, what it would have been at the start of 2019, and where it would have been had you not rebalanced at the start of 2023 and today. And it's pretty eye-opening. If you'd had a portfolio which was 25% in core fixed income and 25% in large cap US equities back in 2019, and you didn't rebalance, you've now got twice as much money in equities as core fixed income. And the reason I think this is important is I know you've been helping your clients rebalance, but sometimes you've got to deal with the tax man, and it's difficult. And so a lot of your clients are probably overweight equities. But the problem is they're probably overweight equities and overweight growth equities. At a time that growth equities within the S&P 500 are overweight themselves. At a time when US equity markets are overweight global financial markets. There is a risk in this concentration. And I know people say, oh, well, maybe this is all going to work out well, and what's going to happen is all the things got left behind are going to catch up. Nah, what's going to happen is we're going to have a bear market at some stage, and all the stuff that's built on fluff and hype and euphoria is going to come crashing down. And you want to make sure that your clients are not in that position. That is why, to the extent that you can, using tax-smart strategies, using fresh money, whatever you can do, try to help people get balanced. I know it's not popular. You know, people always want to just jump on whatever's done well recently. I know that's what people want to do, and it's but having the wrong asset allocation is like not having home insurance. You know, I know it's a pain paying home insurance every year, but you never want to be without it, and you don't want to have the wrong asset allocation for the day markets go wrong. You know, there's a very old saying. It comes from a Greek philosopher, that a man never steps in the same river twice. And it's because it's not the same river, but it's also because he's not the same man. And I think that's really a way of thinking about where we are today and where investors are today. We have been through a lot over the last 5 years in particular. A lot has changed in the economy. A lot has changed in inflation and political conversations. A lot has changed in financial markets. There are risks today that didn't exist back then. There were risks back then that don't exist today. But also people have moved on. People have changed, things change in their lives. People's own portfolios may be far out of balance, even if they were back in balance then. People may have more money now than they had back then, could afford to take different, or have different risk tolerances. I think that's why it's so important to have a conversation today with people about where they are. I have the greatest of faith in the American economy. I've lived in this country for over 40 years. And we've got consumers who don't know how to say no, and we've got bosses who don't know how to say yes. And those things have worked wonderfully well for this economy. People always ask me about, am I not worried about the economy? No, the American economy is an amazing machine. It will look after itself. It's just under no obligation to look after your clients. I think there's plenty of opportunity out there. There's opportunity in many asset classes I haven't even talked about today. I think that this industry has got tremendous opportunity to help people. There are problems, there are issues, and I think we need to give those a hearing. But most days are a good day to invest. And when I look at the economy today, as 2024 winds down, I still think today is a good day to invest. Thank you. Thank you very much.